All right, gents. I know I've been missing you for a couple days now. Can't lie to you. When I say I haven't left work, I haven't. Um, it was all right. 18 hours Monday, another 12 on Tuesday. We survived. I survived. Okay. But now we've got the gusto to continue with these lovely videos. And what else? Other than a pandemic favorite in Etsy, one we like to look at. Now, this stock has seen quite the favorable year, as on the full year chart up 143%. But you see more significant, really, since their dip in March, they're up 480% from last March. So incredible movement on this stock, no doubt. Now you're seeing a downward movement of 8% after hours. I don't necessarily believe it would be from this quarterly result, because I do believe you're going to see some pretty good comps year over year with this result. This is not one that lines up with the quarter that is predominantly impacted. So at least 2/3 of the quarter will not be predominantly impacted by the beneficial macroeconomic environment. With the increased online selling, masks, and the like. They're going to have a lot of tough comp years, or tough comp quarters coming up, because next quarter will be the peak for their sales. It's going to be crazy to see. So my assumption is I think investors are a little bit unintelligent sometimes, if we're being honest, and they don't understand that it's very hard to necessarily keep comp growth going when you've grown like they did last year, 400%. So my guess is they probably are. It's probably a guidance issue. That's what I would guess. That's the tough thing for this company now, because they've baked in these expectations that the company is going to continue to grow 300% every quarter. It's just not feasible. I can't tell you what the big hedge fund managers are doing, but they don't have a brain, right? There's an issue with intelligence. They've got a lot of money, but they don't have the brain to go with it. They need to quit impacting my stock market. Okay, let the good investors win here. Let's look at these earnings though. So let's see. GAAP EPS of $1 beats by 12 cents, and a revenue line of $550 million is up 141%, beats by 20 million. So pretty handy beat, and a nice increase in revenue for sure. When you talk about really close to 1.5 times what they did in terms of business. That's nice. Or 2.5 times, I should say. That is quality stuff. Because, well, I don't think you need to know. Doubling your business is good. But again, I do mention 2 of the 3 quarters were easily should have been comp growth, because they're still seeing some benefit from people using the platform that they gained over the last year that they didn't have prior. So, Q2 guidance. Doesn't seem all that light to me. Revenue of 493 to 536 million. It's quite a wide range for sure. It's lighter than Q1, obviously, so I think that might be where some people could be getting that distinction from. It's weird. It is weird to see a decrease from this company quarter over quarter expected. And I get where that's coming from. It would make sense if it was like Q4 compared to Q1. But Q1, which doesn't have any major holidays or anything, compared to Q2, seeing a decrease could be seen as concerning, I suppose. But it is over the consensus of 493. Interesting, though. General merchandising sales volume looks like $2.8 to $3.1 billion in terms of guidance. Quite a lot of stuff sold on the platform. Where this quarter they sold $30.1 billion of merchandise on the platform too. So, interesting. Marketplace GMS was up 144% to $2.9 billion during the quarter. Nice. GMS per active buyer in the Etsy marketplace on a trailing 12-month basis grew 20% year over year. Not super significant, but we take that as a win because they grew so many users over the last little while that it's good to see an increase. Attracted 6.3 million new and reactivated buyers who haven't purchased in a year or more. That's pretty nice. Habitual buyers grew 205% to mark the highest ever growth for that buyer segment. Those who regularly buy, I guess they call them habitual buyers because it's a habit of them. I would just call it recurring customers, but maybe even regulars. But habitual seems like it's an addiction. Good grief. They generated non-GAAP adjusted EBITDA of 184 million. And obviously, we saw the guidance for a growth of 5 to 15% and revenue growth of 15 to 25%. Not bad. Let's just be clear with each other. That guidance for next quarter really isn't that bad. 15 to 25%. Again, it's because you talk about how much they grew it year over year in that quarter. To see even a further growth is incredible. Yet, these hedge fund investors, right? These people who are supposed to, they're running the market with their money, how they move their money. They're just not intelligent. They don't understand. I mean, good grief, it's rough out here. It's like dealing with 2-year-olds who haven't even learned math yet. And some might know more than them. I mean, good grief. Looking at their press release, why not? It's good to see. Habitual buyers, obviously, they give a definition here. Those with 6 or more purchases, 6 or more purchase days, and 200 or more in the trailing 12 months. It's pretty hard to necessarily call that habitual when you use the platform 6 times in a full year. I don't necessarily call that habitual. I don't know. I think you'd assume at least once a month to be habitual, but 6 times? I mean, that seems a little wild. Quite a general segment. Good grief. Obviously, we saw revenue. Net income coming in at $143 million is up 1,048% year over year. Wowzers. It's good to see profitability out of this company, and quite a darn bit of profitability. Very good to see that. I like seeing that. Obviously, general merchandising sales here up 132%. A lot of merchandise sold on the platform, even compared to 2020. But again, you'll see a much tougher time next quarter in terms of that comp. So we'll see what that looks like. But they're getting 15 to 25%, which would still be a huge win for this company. Huge win. In my perspective, active sellers increased 67%, and active buyers increased 89%, nearly doubled. So that's pretty nice. Pretty nice to see. First quarter highlights. Focus on developing a search and discovery experiences that unlocks the value of our unique items. It pretty well knows your search. Obviously it knows your search history, and it'll recommend items for you, ideally to get people to buy them more. So, nothing crazy as far as other than that. They go into just the basic segments of the business. We understand these, okay? Guidance, obviously, we saw there. Nothing too crazy, all things considered. Doing a look at the balance sheet, and then I'll give my word of wisdom here. Total current assets sitting at 1.89 billion compared to 1.89 billion. Of 3 months ago. It's only 3 months ago, so not a significant change there. But yeah, nothing crazy. Nothing changed on this balance sheet for the most part there. Total assets in general, 2.49 compared to 2.40. So again, very small change. Now 90 million. It's a big change for me, but for them, not so much. Total current liabilities, 427 compared to 454. So it is good to see a decrease there, no doubt. But total liabilities in general actually saw a rise, 1.8 billion compared to 1.66 billion. Stockholder equity fell. Now it's at 683 compared to 742. Overall, pretty nice to see. I am curious why they decided to. Obviously, they grew some long-term debt, I'm assuming in convertible notes, just to raise capital. Just sucks to see that in a quarter in which they grew net income by quite a bit, they managed to see a decrease in this balance sheet. But all things considered, the balance sheet's not in bad health at all. I'd like to see it a little bit larger. That's what she said. But if it could, if they could, that would be not bad. You look at the stock, obviously, they're not giving full year guidance, but Based off these estimates, you're going to be talking around $2.5 billion potentially in merchandise in overall revenue this year. A P ratio of 71. Going to be cheaper after this 9% downward movement, and a market cap right now, prior to close, trading at $23 billion, is not all that expensive. Probably sitting closer to $20 billion now after this huge dip. For a company that's bringing in 10% of that, they're bringing in 1/10 of that in revenue. It's not incredibly overexpensive for a company that's still going to manage to grow pretty decently. But again, if you're going to warrant this high of a market cap right now and PE ratio, I think some people might be expecting continued growth. It's just, you think about it, they're going to continue growing. But if you track this over a 2-year span, I mean, good grief, the amount that they've grown in the last year is incredible. To expect the same number or really the same results now, it's just not feasible. You're going to talk about the fact that they're going to be losing out on some of the markets. One of the major markets for them was face masks. That's going to decrease quite a bit over the coming months. I mean, that ended up being 30% of the revenue one quarter of their merchandise sales. So you're missing out on that segment because those people, let's just be clear, we're getting back to a state of normalcy, less masks. In some states, you're just not going to have necessarily the desire to purchase designer masks anymore. Some people will continue to use them for sure, but that's going to be a segment that they're going to have to make up elsewhere. So we'll see what that looks like. But overall, Etsy, I don't personally like this stock as a buy, just because I don't know. I think the company's good. It's a good company. I just don't personally know what the long-term growth looks like for this one, as there's so many other competitors in the online space that do very similar ideas that are larger. I don't know. Not a buy for me, though, at this valuation. So the dip makes some... I mean, I don't necessarily get the huge dip, but I just think I think it's an overreaction. I don't think you can deny that. When the stock goes down 9%, it's an overreaction, but I still don't think it's a buy, though, even after the 9% dip if it holds. But that's what I got for you.